Hi, everyone. Welcome and thank you for joining us today. I'm Olivia Higgins from futusg Singapore, and this is a joint webinar organized by lionglobalinvestors and futusg Singapore, the moomoo trading app. Now, yesterday we covered the macro trends in 2022, and today we will explore opportunities in the Singapore equity market. And that leads me to our speaker for today, Kenneth Ong. Now, Kenneth is a portfolio manager responsible for the Singapore market within the Asian Equities ASEAN team at Lion Global Investors. And he was previously also the specialist for Indonesia. Kenneth has 12 years of financial industry experience. Hi, Kenneth.
Hi, Olivia. Thank you for having me here.
Thank you for joining us. Thank you. So I understand you're going to give us a presentation on the opportunities in the Singapore equity market, and I look forward to it. So the floor is yours.
Yes, thank you very much. I'm very excited to be here, and thank you, Futu, for giving me the opportunity to share with everyone here the story that I have for the Singapore market. So I'm here to talk about the opportunities in the Singapore market, but first a little bit of a background of myself, my team. Slide 2, please. Here at Lion Global, we have two very experienced fund managers who are looking after the Singapore market. Between Erica and myself, we have close to 30 years of experience, so we have in-depth knowledge of the Singapore market. Slide 3. And just a bit of background as well of our firm, Lion Global Investors. We are part of the OCBC group. We've been around for more than 35 years, and now we are managing close to 70 billion Sing dollars worth of assets. Now, OCBC Group, as you know, is a well-run, conservatively run, prudent bank. So one of our key ethos of the OCBC Group and how we invest is to be conservative with our approach, but at the same time, take advantage of market opportunities to generate the outperformance. Next slide, please, slide 4. So over the years, our firm has received accolades for various funds, but for the purposes of today's presentation, we just like to highlight that on the bottom right-hand side of the slide, that our Singapore Trust Fund has also been awarded Best Equity Fund in the Singapore market for year 2020. Next slide, please. Slide number 5. Now, let me begin the story and the journey of the Singapore market with this one slide here. If there's anything or any takeaway that I'd like you to have from this presentation, it will be the story that's encapsulated in this slide. Now, let me go through in a bit of detail how this works. This is a 30-year slide from the 1990s to the present day of the performance of the Singapore market relative to global equities markets. So how do we read this chart? If you see the chart moving up, it means that the Singapore market is outperforming global equities. And if the chart is coming down, the Singapore market is underperforming global equities. Now, there are a few takeaways here from this chart. The first of which is you observe that there tends to be this 10-year trend of outperformance and underperformance and outperformance and underperformance of the Singapore market relative to global markets. And the backdrop to this is really the global macroeconomic situation. Now, in the early 90s, Singapore markets outperformed global markets as part of the 4 Asian tigers that were driving the global economy. And you see that performance. But subsequently, as due to tech bubble and Asian financial crisis, you see a period of global disinflation and Singapore markets underperformed. Now, if you fast forward to 2000s, with the entry of China into the World Trade Organization, Singapore markets also outperformed as it was an inflationary period. But the past 10 years has been a disinflationary period for global markets, characterized by a period of quantitative easing. Now, in a disinflationary environment, Singapore markets tend to underperform. So you see the reaction of the Singapore market with global inflation cycles. Now, the thing to ask is then what's going to happen in the next cycle? Now, we posit that the next cycle is going to be an inflationary phase. In fact, it's likely to be an inflationary phase over the next decade. And this is going to be good for the Singapore market. And I'll explain further in the next few slides. But the second thing to take away also, if you look at the position in the slides, where we are right now in the chart we're at low levels not seen since the Asian financial crisis. Right? In other words, we are not just a once in a decade low, we are once in 2 decades low in the chart. In other words, a generational low. So this presents the Singapore market as a very interesting opportunity for investing right now as we enter into a potentially inflationary phase next decade. Okay, next slide, please. Why do we think that there's a good chance that the next decade will be inflationary? Well, we have to first look at the past 10 years. What caused the disinflationary period? And then we look and examine, whether these factors have changed. So if you look at a period of quantitative easing, it was a period where central banks were trying to re-stimulate the global economy. But what resulted was that the money that was being printed stayed in the financial system, and few and far between were distributed to the rest of the real economy. So as a result, financial assets went up, but it also led to social inequality across the world. So it has now become a political situation because of social inequality. Next slide, please. If you look at how governments are reacting to this social inequality, not only just caused by the pandemic, but caused by this 10 years of quantitative easing, where the rich get richer, the governments are trying to redress this situation. If they are able to create a more inclusive society, not just in Singapore, but globally, the likelihood of incumbent governments being re-elected will be much higher. So it is the path of political least resistance for governments to want to spread the wealth. Now, how do they do this? Instead of just merely quantitative easing, which is a financial tool, the governments are very likely to channel this money through the form of government stimulus, spending in infrastructure, and that will help to create jobs and broaden the wealth across the economy. So one of the big thematics for the next decade is the building out of global green infrastructure. The demand is there, and so what we need is for governments to take action, use the money in the financial system to build out these green infrastructure, and it's going to happen at least for the next decade. This will be one of the key main drivers of the redistribution of wealth. Now, imagine when the wealth redistributes, whichever stocks that did well in the past 10 years are likely to not do well, and those stocks that didn't do well in the past 10 years are likely to do well. There's going to be an inversion or flipping of the type of stocks that would outperform in the next decade. Next slide, please. What are these type of stocks? Okay, and essentially what I've charted here in the blue line is the relative performance of value stocks over growth stocks. And I've superimposed this value versus growth stocks against the performance of the Singapore market relative to global equities. Now you can see there's a similarity to it. In periods of inflation, value stocks outperform, and in periods of disinflation, growth stocks outperform. Now the growth stocks will be the big tech stocks that have outperformed the past 10 years. The value stocks will be your real estate companies, industrial companies, commodity companies. Essentially, these are real economy industrial companies. So if we're arguing that there's going to be an inversion of the financial market in order to redress the global social inequality, very likely we're going to see an inversion of the performance of value stocks versus growth stocks. And we can see early signs of that. In this chart, most recently in the 2020s, we can see early signs of the bottoming of values underperformance versus growth stocks. We think that value stocks can continue to outperform, and this will be the key tailwind that will drive the Singapore equity market's outperformance against global equities. Next slide, please. So on to slide 9. Now, what I've just described is this big global macro shift that is going to benefit the Singapore equity market. What I'm going to discuss now is from the bottoms up. How does the big macro trends actually flow into the companies that are listed in the Singapore market, and how do these companies actually drive outperformance? There are 3 main areas that from the bottoms up, I see a strong growth in the Singapore market. Okay, the first area is in the convergence of technology. Now, This is through Industry 4.0. Now, Industry 4.0 has been spoken about since 2015 or even earlier. But what's happening now is that the technology is starting to become sufficiently mature for real economy industries to implement Industry 4.0. What are these technologies? For instance, the big data, the data analytics, the artificial intelligence, the blockchain technologies that your big tech firms like your Googles, Microsofts, your e-commerce companies, those technologies that are used by these tech companies can finally be adopted by real economy industries. In what sectors? Well, you can look at, in this chart, you can see these are very familiar sectors: 5G, telecommunications, you've got robotics, automation, as well as manufacturing processes and renewable energies. Now, many of our Singapore companies, especially our manufacturing companies, are positioned in these areas. If you think about smart cities as well, you can think about ST Electronics. Those are the areas that will drive the growth as technology diffuses into these real economy applications. Next slide, slide 10, please. And just to re-emphasize this concept of technological diffusion, if you look at the top chart, whenever we have an innovation, the first thing that drives the innovation is consumer adoption. Consumers must want to use innovation. And once consumers sufficiently use the innovation, then businesses are able to use that same innovation. And I like to illustrate this with the example of Microsoft, which is the bottom chart. If you look at the price of Microsoft share price from the 1990s to the 2000s, you can see that Microsoft share price did very well. And there was an era when Microsoft was selling software to consumers like you and I. And this was the personal computer phase, the business to consumer phase. Now, fast forward to the 2000s, and you notice that Microsoft's share price actually was flat, didn't outperform at all for more than a decade. And what happened? This was an era when there was business adoption. In other words, when Microsoft Office was being adopted in companies, and you can recall how we were using Microsoft Word, Excel, and PowerPoint to improve the productivity of our works in the workspace. Interestingly, when we enter into the business adoption phase, Microsoft's share price did not perform. And the reason is the rest of the world captured the value from this increased productivity. In other words, by using Microsoft Office, all of us benefited, even though Microsoft was the one that came up with the software. In other words, when we move to a business-to-business phase of a technology, the rest of the world actually benefits. So what we're trying to argue here is, as technology moves from the big tech companies of the Googles, Microsofts, Tencents, Alibaba, as the technology moves and diffuses into real-world applications, those companies in the real-world applications are very likely to outperform the big tech companies. And this is from the bottoms up, one of the key drivers of the potential rotation to value stocks over the next decade. Next slide, please. And on slide 11, what are some of the companies that can benefit from this technological diffusion? I've listed two here. The first bucket are what we term blue chip companies. In other words, they are well-known household names in Singapore, former blue chip companies whose share prices have actually fallen quite a fair bit, partly due to the pandemic, but also due to their individual sectoral difficulties. What we're seeing is, across the blue chips, we're seeing corporate restructuring, we're seeing cyclical recovery in their industries, but more importantly, we're seeing them adopt big data and artificial intelligence technologies into their business models. So as we see this transition, we can see the companies position themselves for the next decade using these technologies. So this is the first category of companies, the blue chips. The second category of companies are what I term as the survivors. And these tend to be the small and medium enterprises in the Singapore economy who support, in part, the blue chips, but also support global supply chains. Now, if you are a survivor, you would have suffered through the past 10 years of low GDP growth, low revenue growth in Singapore. But what you have done is you've probably gained market share from some of your competitors who have gone bust, or you have repositioned yourself into new growth areas, such as in the areas of semiconductor, medical, robotics, and even renewable space. A lot of these small medium enterprises have embedded technology and are repositioning themselves for this growth phase. And we are starting to see that the opportunity set for the survivors is getting larger and larger as they have strong balance sheets and strong business models. So these survivors are able to embed new technologies and drive the performance of the Singapore market in the foreseeable future. Next slide, please. And moving on to slide 12, the third area where I see the Singapore market having a strong growth potential would be in our financial sector, our Singapore banks. Now, Singapore has become the preeminent British rule of law jurisdiction in the Asian region. In an era where you have geopolitical risk and with money being printed and wealth being generated, Singapore remains a very attractive safe haven status. And we see evidence in that, not just in the physical property space, where we've recently heard a lot of headlines about good class bungalows being bought up by the new rich, but also we are starting to see many family offices opening up in Singapore as liquid wealth flows into the nation state. So our Singapore banks are well positioned in the property and wealth management spaces. In fact, about 50% of the loan growth in the Singapore banking space is related in some part to the property and construction space. So as Singapore continues to attract wealth with its AAA status, and we continue to expect that the banking sector will be the bedrock that drives the growth of the Singapore market. Next slide, please. Slide 13. And I'm sure you're aware that Singapore is a high dividend yield market, but just to illustrate on this table that amongst the AAA jurisdictions, Singapore offers the highest dividend yield. And this is good not only for investors based in Singapore, but it also attracts investors across the world. When money from the rest of the world comes into Singapore, attracted by dividend yields, we're going to see outperformance of the Singapore stock market. Next slide, please. And so I've given you, the big macro shifts, and bottoms up, what are the key drivers of the Singapore market. And just very briefly, I'd just like to touch on our fund, which is the Singapore Lion Global Singapore Trust Fund. Picture speaks 1,000 words. On this slide, we have a peer comparison between our fund and our competitor funds. We are the chart in blue, as you can see. We are the best performing fund amongst our competitor set. Next slide, please. And we've been running this fund since the 1990s. And over time, you can see this compounds. The outperformance data speaks for itself. And so, we are very well positioned to identify the big macro trends, the bottom-up trends, and also then translate this into our fund performance. Next slide, slide 16. So in summary, just to recap the key thesis for the Singapore market. First of all, we've got a big macro shift that is happening in the global financial system. The past 10 years of quantitative easing is likely to make way for the next decade of government stimulus that's going to drive a rotation into value stocks. And the Singapore market, being a value biased market, is going to benefit from this tailwind. The second key highlight is that, the Singapore market is a dividend paying market. In other words, you're paid to wait and there's safety and security in the dividends. But at the same time, which is the third point, you have the optionality of growth. So you've got the dividend and a dividend plus growth strategy. And that growth is driven from the bottoms up as companies in Singapore embed new technology into increasing productivity and value creation. So I've come to the end of my segment. I'm very happy to take on Q&A and hopefully we have an interactive session. Over to you, Olivia.
Thank you, Kenneth, for your expert analysis and presentation. Now, I learned some key elements of the evolution of Industry 4.0 and smart cities, right? It's up and coming, and also the key drivers in the Singapore equity market. Now, if you have any questions for Kenneth, do leave a comment and we'll get to it at the end of the webinar. So keep taking notes because we're here to help you and provide you with the educational tools to make better investment decisions. Now, you've heard the analysis But how do you exactly get access to LGI's funds? Now, if you have your Moomoo app with you, I'll show you very quickly and give you a summary on how to navigate funds in app. So take out your Moomoo app. When you first enter the app, it'll look just like this, right? You look for MoneyPlus. Click on Fund Houses on the top, and you should be able to see, for the purpose of this webinar, we're going to use Lion Global Investors. Now click on the LGI icon, and you should be able to get the full listings of the funds run by LGI. Now over here, you'll see a full comprehensive data list on what you'll need to know about LGI, what the fund house entails. And if you have access to the fact sheets, you'll also be able to get the performance and the subscription details. Now, you can see in the app, here's all the information you need to know for the general profile. Over on the right-hand side, you've got the NAV, the net asset value, to calculate the change in price. And then you can see a general overview here. But I think what is also important is to really go into the details. So under financial funds, you'll be able to not just know what the company invests in, but you can also find out under position details what the specifics are. You'll also be able to assess the weight of each instrument, the performance, the type of region, the sectors that they're involved in. And I think this is great data for you to work with at the start. Now, for subscription, it's also a great complementary tool to help you gain a better understanding about the fund house's strategy and overall concept. Now, for my personal favorite, the news feature, because I think it's an excellent tool to keep you on top of all of the news. And it's really important because there are a lot of keywords and buzzwords out there. But for this feature, you're able to really look at it from a cross-channel approach and see a summary for each article with the details. Now, I understand that sometimes the details can be a little overwhelming if you'd like to take a more macro approach. So in this case, you can access the entire summary of this profile under summary. And it's essentially the basics, really, the country, the fund documents, and the most important part, I would say, the fund managers. Now, if there is one key takeaway from this demo, it'll be this. So in determining a fund house to invest in, I think it's also crucial to both measure performance and also find someone that you trust to manage your portfolio. So this is an active management portfolio tool and a feed. So you're able to assess the credibility, the details of the managers involved in this fund, and overall the people you can trust to invest your money. So if you have any more questions about this feature, you can always leave a message for the team and they'll get back to you. Now, overall, it's really about giving you the comprehensive data, right? So be sure to check it out. And I hope that was helpful for you guys watching. All right. Now, I would like to invite Kenneth back into the room because we're on to the most exciting part of the webinar, the Q&A. So, Kenneth, the first question, a viewer would like to know, how would the inflation and interest rates outlook influence the Singapore market?
Yep, that's a great question. And it's a very topical question because inflation is now pretty much on the headlines everywhere. Perhaps if we can draw up the slide number 5 again. And essentially, you know, as I've mentioned, the Singapore market actually reacts positively to inflation. Mm-hmm. And maybe let me just go into a bit more detail about this. The reason for that is because the Singapore economy is a very open economy. And, you know, a lot of our companies are actually plugged into the global supply and commodities chain. We are not a consumer-led economy. So when you have a situation right now where you have, you know, tightness in supply chains across the world, it is actually producer prices and commodity prices that are driving inflation, even though consumer demand is not back to its fullest. So it's not really a consumer-driven inflation is actually a producer-driven inflation. And because Singapore economies are on the production side of things in the global economy, rising producer prices are actually positive for the Singapore stocks, Singapore companies. And that is why, on one hand, you see the Singapore stock market perform well during inflationary periods. And that's pretty much what slide 5 tells you. Now, there's also as part of the question where interest rates are going. And it's really interesting, the concept of an interest rate is really, if you go back to the basic etymology of the word interest rate, it's essentially the level of interest that people have in taking out loans. So interest rates go up when more and more people want to take up loans, right? So that's why you have an interest rate, right? And so why do people want to take up more loans? That's when they have a more positive view on their own personal lives, but also on the economy around them, right? So as we move into a situation where interest rates go up, essentially what we're saying is actually global economic activity must go up, right? So that is also the other reason why if you're seeing higher interest rates, it means that global economic activity is going up, and that would drive demand for supply chains. Again, Singapore market outperforms. So slightly two different concepts, inflation and interest rates, but directionally, the Singapore market does well when both of them go up. Now, there's one last aspect to this inflation, which is that in the near term, we are seeing a supply shock inflation. In other words, because of the pandemic, a lot of supply chains are not fully running. You're seeing the supply shock inflation. But realistically, global growth has been weak for 10 years. And this is why, and in addition to that, the world is actually aging, especially in developed economies. So there is an incentive for governments to want to stimulate growth. And in order to stimulate growth, you have to have more infrastructure projects. That is the only way out, right? So that is why our thesis is that there will be more government spending. When there's more government spending, there's more jobs created, there's more economic activity, therefore interest rates go up, therefore it will help the Singapore market. So there are a few parts to it, but hopefully I've tried to address, all the complexities of this inflation question.
Excellent. Very comprehensive, Kenneth. Now, one viewer would like to know, what are some technological sectors that we should be wary about or be more conscious of in the next decade?
Is there an elaboration to the question? When you say cautious, are you worried that in terms of sector underperformance? I guess yes, yeah, okay, I can
specifically for technological sectors, yeah.
Okay, so when you have a situation when global inflation goes up and when interest rates go up, obviously the valuations of technology companies are going to be impacted. And the reason for that is because an era of cheap money, past 10 years, low interest rates, enable technology companies to actually buy the demand. In other words, if you're an e-commerce company, you've got cheap money, you're basically giving out free shipping, you're essentially buying demand, right? So when you're able to buy demand in a low interest rate environment, that's great, and your stock valuations go up. The problem is when the cost of money goes up and you're not able to do that anymore. Therefore, the valuations of tech companies come down. Now, there are, in the next decade, if we do expect an inflationary environment, there will still be certain tech sectors that are likely to continue to do well. The key metric of this is that whichever technology it is must have an increasing total addressable market, the TAM, total addressable market. In other words, if your total addressable market continues to expand, even with rising interest rates, your stock price is likely to go up. One possibility, I'm just saying this is a possibility as I'm not an expert in this, but one possibility is, for instance, Tesla, right? Now, people are very puzzled about Tesla's share price. It keeps going up. But the reality is that because it has such a hold on a certain consumer segment and an ideology that, on going green, Tesla is not only able to sell cars, they are probably going to enable you to buy their solar panel, and that solar panel is probably going to fund electricity for your car. So as technology companies increase their total addressable market, for instance, moving from car to solar to something else, if you're going to move into adjacencies and your total addressable market keeps increasing, regardless of the interest rates, chances are your stock price is going to go up. So that's one. And number two, the technology companies that are going to help in driving the business-to-business diffusion of technology as real economy companies, embed these artificial intelligence companies. Those technology companies that are helping real businesses do that, they also stand to benefit. And one of the companies that we've observed is, for instance, Accenture. Now, Accenture, as you know, is a global system integrator company. And very interestingly, for the past 20 years, it has done very well, relative to the US market. But recently, Accenture's share price has also outperformed the US market. And in a recent transcript, the US Accenture CEO mentioned that companies are really starting to shift onto the cloud. And those that are already on the cloud, they're starting to shift into data analytics, right? So these tech companies that are not just targeting B2C, business to consumer, but targeting B2B, these are the companies, quite likely, they will benefit, right? So we're starting to see this shift in technological leadership. At least these are the two trends that I've personally observed.
Well, Kenneth, that's a great point. I also think, you mentioned about the hardware, and then there's also that software element where that just complements the entire pie. And I think a lot of these new economy industries, they're accelerated in this sense, and they have, a lead on this. It's great. I mean, going back to your presentation about smart cities, about even just robotics or even quantum, right?
Absolutely. I think the key issue that we find, and we look for company managements that have these characteristics, is their ability to shift their mindset. What I observe is if you're a CEO in your late 40s, or 40s, 30s, 40s, 50s, you're probably very open to new technology, and you're willing to take that bet. Chances are, if you're in your 60s, right, somehow the ability to shift mindset, right, is a bit slower. There are of course exceptions to the rule. Piyush Gupta from DBS, he's in his 60s, but somehow he has a very youthful mindset. So it depends. But if you want to know what we look for when we meet companies, it is essentially this: the ability for senior management to identify data as essential in their corporate strategy.
Thank you, Kenneth, for that. There seems to be a fair interest in the Singapore property cooling measures. And so one viewer would like to know, what are your views, Kenneth, on Singapore property stocks with the recent cooling measures and the anticipation of property tax hikes?
Okay. So the short answer is that there is a difference between Singapore property stocks and the Singapore physical real estate market. Now, the Singapore physical real estate market is likely to continue to be very attractive for global investors, precisely because we are a safe haven, and increasingly more so during this period of geopolitical risk. So, as you know, geopolitically, Singapore is sandwiched between big powers, right? It's pretty much like a Switzerland of the East. And it has been like that since, 65 or 70s, and it will continue to be like that. So over the next 20, 30 years, at least in a generation, safe to say that the underpinnings of the Singapore physical real estate market is going to be there. That is why the government would always want to temper the rise in the physical real estate prices. So whenever I see cooling measures, I actually think the opposite, right? Instead of saying that, oh, that's actually bad for the market, it actually reflects that the underlying demand for the physical real estate is actually very strong. So it's actually a bullish signal for the long term. So that's on the physical real estate market. Now, when it comes to the property stocks, it's a different thing altogether. In the past, the property companies used to be able to land bank, but due to changes in government regulation, companies are now only able to hold land bank for 5 years. So instead of being able to benefit from the appreciation of the land, the Singapore property companies are now forced to keep replenishing their land at higher and higher cost. So it becomes more like a mouse running on a treadmill. You just have to keep buying, right? And yes, your margins will always stay the same, but you just have to keep working, right? So they're not in a great shape. In fact, we prefer the property agents. For instance, like your Propnex and your ERA, they give very attractive dividends as well, right? So in the past, our funds also invested in these companies, and we've benefited from their share prices, right? So there is a difference between the listed real estate companies as well as the physical real estate prices.
Mm-hmm. Okay, thank you, Kenneth. Is it a good time to invest into the Singapore stock market given the recent volatility in the US stock market? So, yeah, this was also a popular question recently, talking about volatility and perhaps speculation. What are your thoughts on this?
Yeah. So again, back to our key slide number 5. If you look at where we are relative to global equities, now in this slide 5, global equities is essentially 60% US market, US stocks, right? So relative to US markets, we are really at a once in a generation low since Asian financial crisis. But if you think about it, our companies right now, balance sheets are much stronger than back in the Asian financial crisis. So whenever you see a low in the chart, right, like this, it always smells an opportunity, right? The difficulty I always have is whenever you're at the bottom of any cycle, you will get more naysayers than supporters, and that's very natural. Absolutely. Right? Because you're right at the bottom. People always fear the worst, right? So this is why we've been pushing this Singapore story actually since last year, right? We are expecting this to be a once in a decade trade. We're looking at a 10-year cycle. Of course, in the next 1 or 2 years, it takes time for things to bottom out and to turn. But what's important for our viewers here is that to be aware that yes, we are at a low, and yes, we have supportive factors, and just be aware that there is such a major shift going on, not just from the Singapore context, but from the global financial macroeconomic context.
Mm-hmm. And I suppose, there's a bold question here, and I think it's an important question. Someone would like to know, do you think the Singapore market is a mean reverting market where there are no sustainable long-term returns?
Absolutely. This is exactly the question that I would love to address, right? And I remember reading a Business Times article saying that if you look at the past 10 years of the Singapore market, right, it has underperformed the US market for X and X percent. Mm-hmm. And so you should invest in the US market. And this article came out a couple of months back, 2 or 3 months back. Mm-hmm. It depends on the time horizon that you're looking at. If you're looking at the past 10 years, if you look at slide number 5, mm-hmm. right? Obviously, you're going to come to that conclusion because you've seen 10 years of underperformance, right? But it's precisely because of this underperformance that we have this market opportunity where we're right in the bottom. Now, what I've explained is, you can look at the individual companies, you can look at the individual stocks. And you can try to rationalize, okay, why is CapitaLand doing this? Why is DBS performing this way? Why is SIA performing this way, for instance, right? But really, the major moves in the Singapore market is driven by macroeconomic factors. And the simple reason is that our economy and our financial market is small in the context of the global financial system. We are like a small little boat. We're like a sampan, right, in this global sea of finance, right? And if the global sea of finance, the waves, if the winds change, that's where you get the best opportunity. And what I've explained is, if you look from the macro point of view, there is a political impetus to redress social inequality. And by doing so, you're going to flip the entire financial system around, and there's a good chance that value stocks will have a sustained outperformance over growth stocks. So this is really the key shift. And you have to look not just 10 years, you have to look at least 30 years to come to this conclusion.
Absolutely, I agree. And I think even for myself, a new investor in different industries, it's really important to really pay attention to key analysis and look way ahead into the future. I count myself as a futurist, so I really enjoyed the topics that you brought up today, and I'm pretty sure that everyone watching benefited as well. Now, Kenneth, what would you like to tell the viewer as a key takeaway or final thoughts?
Great. Yeah, I think just as a summary, we are, we're at an inflection point in the Singapore market. Right? As I explained, there's a big macroeconomic shift happening from the top down, and from the bottom up, we're starting to see technology being diffused into the companies in the Singapore market. So we are bullish on the Singapore market. In fact, I've been covering this market for coming 12 years, right? Mm-hmm. I've always been generally conservative in the market, but with this post-pandemic recovery, we're finally turning bullish after 10 years. So that's number one. And I think if you look at the performance of our Singapore unit trust, you can see that, we're not just telling a story here. We actually identify these trends early. We work with our investee companies and we translate that into our fund performance. So for those who are looking, to invest globally, I think the first takeaway is, do take a look at the Singapore market. It's been forgotten for 10 years. And I think the time is ripe over the next 1-2 years, starting from now. And, bear in mind, Lion Global Investors as well, we have a strong team with a strong track record. And again, we've partnered with a strong partner through Futu. So thank you very much for having us on this platform.
Thank you so much, Kenneth, for joining us. And I really benefited with all your expert analysis and presentation today. Thank you.
Thank you, Olivia.
Now, for the viewers out there, remember, we're here to provide you with the educational tools to help you make better investment decisions. So stay tuned for tomorrow, our next webinar happening at the same time at 3 p.m. And we will continue the discussions there. Now, if you have any more questions for today, for Kenneth, for our speaker yesterday, do let us know and email our team, or you can keep up with our socials for more updates. Now, thank you, Kenneth. Thank you to our viewers. Once again, I'm Olivia Higgins, and we'll see you for the next webinar. Bye.